Right now, across the United Kingdom, the housing market is entering one of the most fragile, uncertain, and psychologically unstable periods in its modern history. This is not a dramatic overnight crash announced by emergency press conferences or flashing red headlines. There are no sudden sirens, no single moment that marks a collapse. Instead, what we are witnessing is something far more dangerous, a slow, grinding breakdown happening quietly, steadily, and in plain sight. This crisis is hidden behind national averages, smoothed over by selective data points, and softened by optimistic forecasts that focus on isolated improvements rather than the broader structural damage underneath. To many observers, the market still appears functional. Homes are still being sold. Prices have not collapsed nationwide. Mortgages are still being approved. But history shows that housing crashes rarely begin with chaos. They begin with hesitation. For ordinary households, this crisis does not arrive as a headline. It arrives as a property that fails to sell, as a buyer who pulls out at the last moment, as a mortgage offer that suddenly falls short, as an asking price that quietly gets reduced once, twice, sometimes 3 times, without attracting interest. This is how housing downturns actually begin, not with panic, but with paralysis. On the surface, house prices appear to be holding up. In some regions, they are even ticking slightly upward month to month. Some commentators have been quick to declare that the market has turned a corner or that a recovery is underway. Others argue that falling interest rates will soon unleash pent-up demand and reignite price growth. But when we look beneath the surface, at transaction volumes, affordability ratios, regional divergence, buyer behavior, lending standards, and confidence, a very different picture emerges. The UK housing market is not booming. It is not even stable. It is stalling, and in a growing number of areas, it is already retreating. According to the UK House Price Index, annual house price growth slowed to just 0.6% by the end of 2025, with several regions recording outright price declines. UK House Price Index, gov.uk 2025. That headline number alone represents a dramatic slowdown compared with a post-pandemic surge. But averages hide stress. The regional breakdown reveals something far more concerning. London, historically the strongest and most resilient housing market in the country, is now among the weakest performers. Prices in the capital have fallen by approximately 1.4% year-on-year, with flats experiencing the sharpest declines. UK HPI 2025. This is not a trivial shift. London has long acted as the engine of the UK housing market. When London weakens, the effects ripple outward to the southeast, commuter towns, and eventually the rest of the country. Flats have been hit particularly hard. Many were purchased at peak prices during the pandemic-era boom, often with minimal deposits and ultra-cheap mortgages. As interest rates reset and demand fades, these properties are now some of the hardest to sell, especially newer developments with high service charges and limited appeal to families. But prices alone do not define the health of a housing market. Liquidity does, and liquidity is disappearing fast. In April 2025, residential property transactions across the UK were 28% lower than the same month a year earlier, HMRC and UK House Price Index data, 2025. This is not a seasonal dip. It is not a blip. It is a market freezing in real time. When transaction volumes collapse, the damage spreads quickly. Sellers become trapped, unable to move or refinance. Buyers hesitate, fearful of overpaying. Property chains fall apart. Estate agents report fewer viewings and longer sale times. Mortgage brokers see deals collapse at late stages. And perhaps most importantly, confidence begins to drain away. This pattern is not new. It mirrors the early stages of previous housing downturns, including the global financial crisis of 2008 and the post-interest rate shock slowdown of 2022. The warning signs are the same: falling transactions, rising listings, widening price negotiations, and growing uncertainty about future values. One of the clearest indicators of stress is a widening gap between supply and demand. Data from Zoopla shows that the number of homes listed for sale across the UK has reached its highest level in 8 years, while buyer demand remains around 10% below pre-interest rate shock levels. Zoopla UK Housing Market Report 2025. In simple terms, more homes are being put on the market, but fewer buyers are willing or able to commit. This imbalance is critical. Housing markets rely on momentum. When supply outpaces demand, sellers are forced to compete with one another. Buyers gain leverage, and price pressure builds slowly but relentlessly. As a result, price reductions are becoming the norm rather than the exception. Zoopla reports that more than 60% of sellers have already reduced their asking prices in an attempt to attract interest. Zoopla, 2025. In many cases, properties are being reduced multiple times. Homes are sitting on the market for months. Viewings are sparse, and negotiations are tougher than at any point in the past decade. The gap between asking prices and achieved sale prices is widening, a sign that expectations have not yet fully adjusted to reality. Many sellers are still anchored to peak valuations from previous years, even as market conditions deteriorate beneath them. This pressure is now clearly visible in loss-making sales. Analysis by the Financial Times, using land registry data, shows that nearly 15% of homes sold in London during 2025 were sold for less than their previous purchase price. Financial Times, 2025. For flats, especially those bought between 2019 and 2022, the proportion is significantly higher. This represents a major psychological shift. For more than a decade, London property was widely viewed as a near-guaranteed investment, a one-way bet on long-term appreciation. The return of widespread loss-making sales challenges that belief and undermines one of the core assumptions that has supported high prices across the UK. Loss-making sales are rarely voluntary. They are usually driven by necessity, job relocations, divorce, refinancing pressures, rising mortgage costs, or broader financial strain. Once these sales increase, they tend to reinforce further price weakness by resetting comparable values and lowering expectations across the market. At the heart of this slowdown lies a fundamental and deeply structural problem. Affordability is broken. Even though mortgage rates have fallen from their 2023 peak, they remain far higher than during the ultra-low interest rate era that defined the previous decade. At the same time, house prices remain extremely elevated relative to incomes. Nationally, average house prices still sit at 8 to 9 times average earnings, and far higher in London and the Southeast. ONS earnings data in UK HPI 2025. This imbalance means that even small changes in mortgage rates now have outsized effects on monthly repayments. The Bank of England has acknowledged that affordability has become one of the biggest constraints on housing demand and a key risk to financial stability. Bank of England Financial Stability Report 2025. Buyers today are far more sensitive to economic uncertainty than in the past. Rising food prices, energy bills, council tax, and general living costs leave little margin for error. A single rate increase, job loss, or unexpected expense can push a household from affordability into financial stress. House builders are already responding. Major developers such as Taylor Wimpey and Persimmon have warned that buyer demand, particularly among first-time buyers, remains weak despite incentives, discounts, and support schemes. The Guardian, January 2026. Reuters, January 2026. Slower sales mean delayed projects, reduced construction activity, and fewer new homes entering the market in the future. Meanwhile, the buy-to-let sector is under sustained pressure. Higher mortgage rates, reduced tax relief, stricter energy efficiency regulations, and rising compliance costs have pushed many landlords to exit the market entirely. UK Rental Market Analysis 2025. These exits have further supply to the housing market just as buyer demand weakens, intensifying downward pressure on prices. Paradoxically, rents continue to rise. According to the Office for National Statistics, average UK rents increased by around 8 to 10% year-on-year in many regions during 2025, ONS Rental Index 2025. But rising rents are not a sign of housing market strength. They reflect shrinking rental supply and increasing competition among tenants. High rents trap households in renting, making it harder to save for deposits while doing little to boost buyer demand in a high-cost mortgage environment. This creates a vicious cycle. Renters cannot buy, landlords sell, rents rise further, and pressure builds. What we are witnessing now is not simply a housing slowdown, but a crisis of confidence. Housing markets do not collapse when prices dip slightly. They collapse when belief breaks. And right now, belief is fragile. Buyers are delaying decisions. Sellers are cutting prices reluctantly. Builders are scaling back. Lenders are quietly tightening criteria. Investors are increasingly cautious. This combination of hesitation and retreat is exactly the psychological pattern that has preceded every major housing downturn. The UK housing market today is not in freefall, but it is standing on unstable ground. Prices are stagnating. Transactions are falling. Affordability is stretched to its limits. Loss-making sales are increasing, and confidence is eroding month by month. This is not yet a crash, but it is a foundational one. What happens next depends on interest rates, inflation, employment, and confidence, all of which remain deeply uncertain. For buyers, caution is essential. For sellers, realism is unavoidable. For renters, relief remains distant. And for policymakers, the margin for error is shrinking. The UK housing market has reached a critical moment. The next shift, whether triggered by economic data, interest rate decisions, or sentiment, could reshape the market for years to come. And this time, everyone is watching.